Okay, we're going to be outlining the 1200 pip move we mentioned in the money management, lesson number 5. And obviously, just a brief recap as a refresher, just in case you came back to this lesson solo without going into 6.1. When we're looking at a premium market, and markets are trading near a premium, and we have reason to suspect that a lower future price is in order, we don't know how much time it's going to be needed to get to that lower future price, but we're looking for a displacement in price and vice versa. In this example, we're going to be focusing on a buying opportunity when a market went to a deep discount on a monthly, weekly, and daily time frame, and how we would use that insight to get to a higher premium future price. And briefly, just as a quick overview again, since this teaching is going to be specifically dealing with the discount opportunity, buying at a discount, and aiming for premium objectives, our focus is down here where mitigation blocks, bullish breakers, liquidity voids, fair value gaps, bullish order blocks, rejection blocks, and old lows or old highs are our focal point for entries on long positions. The idea is we're looking for something down in this list of arrays to target one of the premium arrays. Now, obviously, the first one we'll be reaching for is a mitigation block. That would be a first objective. Then if there's a breaker of any kind, we would aim for that, and we'd have to weigh out whether or not there's a significant force that would drive it through a breaker. And we'll talk about that should we come to it in our example. And then obviously looking for any range to be filled in for a liquidity void, and aiming for fair value gaps in the premium range of the market. And then we would look for fair value gaps, bearish order blocks, and then looking for a rejection block and or old high and old historic low. So we're looking for bullish PD arrays to buy into with the expectation of selling it at one of the monthly premium arrays. If we were looking at a bearish example, which is what we're not going to be doing here, but just for the sake of completeness, we would be looking to sell short at a bearish PD array, aiming to cover that short position with one of the bullish PD arrays: mitigation block, bullish breaker, liquidity void, fair value gap, bullish order block, rejection block, and or old low or historic high. So selling at a premium and buying back at a discount. Before we get into our actual example, I want to give you some study points so we keep it in mind when you are looking at price. It's important you keep this as one of the focal points when you're studying. When markets are at a premium or at a discount, they're always going to initially look to rebalance. That means the equilibrium price point between the last recent range. So even if it doesn't go all the way up to a deep premium or down to a deep discount, you can always reasonably expect it to go back to equilibrium. And if that's all you aim for, if you buy at a real deep discount and just get back to equilibrium, you'll find a lot of trades like that. If you're at a big premium in the marketplace, you're at historic highs or an annual high or 3-month high, you got a real good chance of seeing the market sell off back to some equilibrium price point of the most recent trading range. When markets are in a premium, again, and if you're at equilibrium, you're going to be focusing on the market potentially moving up into one of these monthly PD arrays that possibly may be a shorting opportunity. When the market's at equilibrium, you can anticipate a market move down into a monthly discount, aiming for one of the PD arrays as an objective. So basically at equilibrium, you can look for either expansion on the upside or downside. Now you're going to be consulting the market structure on the monthly chart to determine what side of the marketplace you're going to be looking for. So it's not indiscriminately going in there, rolling the dice and saying, well, I'm going to sell it short because it's at the middle of the range, or I'm going to buy it at the middle range. You have to look at some of the criteria around that price action at the time. Weekly ranges, just as a complete approach or overview, all of the same PD arrays for premium and discount are the same, and the same is said for the daily chart. So we're going to go over to the charts now and look at the Japanese yen cash price. Okay, we're looking at the daily of a cash price for Japanese yen. This is seen at barchart.com. And historically, last year in 2016, we made a high in August, and the market showed willingness to want to start breaking down market structure at this low here. This low became broken at this moment here. So market structure on a long-term basis on a daily chart had been broken bearishly. And we see this Trump election rally up into bearish order block, and then it sells off. So we're going to be looking at this move in here. Okay, and we're going to go over to the Forex chart. Now, just so you understand clearly, because a lot of you may be new and maybe you're used to trading the futures market or following the Japanese yen cash price, but when we pair it with a currency like the dollar index is the front currency, and then the Japanese yen is the second. So that means if we're bearish or expecting lower prices on Japanese yen cash prices, the dollar yen pair is actually going to be inverted. It's going to go up, because if Japanese yen cash price is dropping, that means dollar prices are rallying. And if the dollar is the first in the name of the pair, dollar yen, that means when you're watching dollar yen price action, you're watching the advancement of dollar versus the decline of the Japanese yen. Okay, here's a monthly chart of the dollar yen. Okay, and you can see how we've seen the market have a really nice rally up in here. And it's going to be, again, diametrically opposed to what we expected, or just saw rather, on the cash price on the Japanese yen. Now, as a reminder for some of you, we talked about the Japanese yen in the beginning months of our mentorship. And I gave you some study points and gave you some examples about this move higher and some of the levels that we saw it trade to. The 118, for instance, was one that was mentioned. So if we look at what has happened and what's transpired, we're going to map out this monthly chart, and we're going to get some levels on here. We have a high back here. Okay, and I want you to take a look at these equal lows. Okay, the equal lows in here, we're going to be expecting what to be there? Sell stops. So while the market was dropping last year, we would be expecting it to trade down into these levels. Now, what's this over here? These two down candles. That is a bullish order block when you blend both of the bodies together, because it's two consecutive down candles. Okay, and that gives you your equilibrium price point in here. Okay, we'll take that off and round it to the full 99 level. So we have a range here. We have a high end or premium and a low end or discount. What makes this a discount level? The fact that we saw price move away from it here. Now this could be a discount level as well. We want to go back to where the move originated here. We saw a big move away here that left a gap open. So we saw the dollar yen leave a gap open here where price was only delivered on the upside. There was no down movement to counteract that up move. That was seen here. Okay, it came down and closed in that little range in here. Okay, so price comes down, hits the full big figure 99. Okay, so we have a defined range. Up here, this is premium on the monthly level. This is discount on the monthly level. So on this level down here, we would look to see a move below these wicks in here, the bodies of these candles. We saw it right in here. This candle comes in at November 2016. It went below the bodies of the candles in here. That is going to be a rejection block. It cleared out the bodies of the candle on a monthly chart, rejected, sent it higher. Okay. We have a range up here. We also have this down candle, which is a breaker. Why is this a breaker? Because we have an old high here. Old highs, anyone that gets short, they're going to put a buy stop resting right above that. If the market rallies above, clears out those buy stops here, and then trades down through it. Once this down candle is violated right here, it becomes a valid breaker. If it trades down below it and comes back to it here, we have it. Middle of the body of the candle, extended out in time, it would give you a level to watch. This is actually a weekly level. We're going to see very clearly when we drop down into weekly range. But we also have, notice we have a gap in here, which I'm not going to add all this on this chart because it'll make it way too busy. But we have a gap in here. Price has only been delivered on the downside between this candle's low and this candle's high. It's been delivered down here as a gap, so that would be one reasonable objective to look for when price was rallying. But what makes the buy down here? We're going to discount on a monthly. Let's change it over to a weekly. Okay, here's the same dollar yen, just in a weekly format. Okay, you can see here we have an up candle right before the down move. Okay, that's a bearish order block, so we're mapping that opening out over to here. Okay, and the reason why I'm using the open on this candle, not the wick, is because there's an absence of a gap. The reason why is because we have a wick here and the market traded down through here. So this is 2 times this little area has been traded to, and it was blocked in with this candle's high. So this whole little area in here wouldn't be viewed as a gap or a fair value gap. It's been closed in because the very bearish order block itself had a movement lower initially, so it's been passed through twice there. Price comes up and closes it right to the opening. So we also have a gap in here, fair value gap here between this candle's low and this candle's high. That would be an objective to reach for also. But I want you to look at the weekly chart. We're deep in a discount on the range, and price shows a willingness to want to rally and comes back down into the down candle right before the up move. This is a bullish order block. You could be a buyer here, but we're focusing on that November long. That's this move right here. It's trading right back into and recapitalizing an old weekly bullish order block. Notice, see what it's done? It's hit that right there perfectly and rallied away. Now, on a weekly time frame, this bearish order block, which is the last up candle right before the down move, this is what you could have on your charts as well. This is how you map out the conditions. Okay, so that would be a reasonable objective. Once price comes down, hits it, this buy here shows it hit that. But then we had this set up here, so this is later on. You don't really see this as an objective once it's already been hit. This wouldn't be no resistance whatsoever. So you can take that level, move it over to here. That would be a reasonable objective on the upside, closing in that range. But now look at the bodies here. See that? Equal body candles. Above that, we would expect to see a rejection block. Price reaches through that as well. Another rejection block candidate here, equal bodied candles. We can expect to see that as an upside objective as price continues to trade higher here. And then we have that fair value gap up in here where price has only been delivered on the downside. That would be an objective over here. You can see that. I'm not going to move this line all around. And then finally all the way up here to the bearish order block, which is the last up candle right for the down move. So we have a discount to premium using the monthly and weekly charts. But now let's go down into a daily time frame. After I add one more little thing to this. We also have this last down candle right before this buy occurred. So right in here, we're going to map that out with a different color, so that way we can see the hierarchy between the weekly and the daily. Let's use a different color, that a little bit darker. Might be a little too dark for some of your personal taste, but we're just going to have to deal with that, won't we? We're going to go over to a daily chart. Okay, and you can see here the darker area is a weekly bullish order block. This is the lower weekly order block, and this is the higher weekly order block. The price comes down and hits that and actually touches both. It gives you the return back to lower weekly order block that's bullish. So it trades 2 times into a higher order block on the weekly chart and the lower of the 2 bullish order blocks. And price rallies away and through. Right here on this November buy, same thing we start seeing here on the daily. We see an old high here, We see an old high here. We have equal highs in here. We have relatively equal highs here as well. We have a fair value gap in here. This high and this low, which is what that would have been on the weekly chart, by the way. And then we have the last up candle right in here. That low comes in at 118.55. So 118.55. So you can see how prices reached up into premium level over here. Now, important thing is if we don't see any retracement to come back into for a daily bullish order block, or if we saw, for instance, let's say it like this. Zoom in. We have this down candle right here. Okay, price rallies away from it. Every time you look in an uptrend, you want to focus on the down candles because that's where institutions are going to buy. Either they're buying at the time of the down candle's creation, which is usually always the case, and then if it comes back to that same down candle at a later time, they will buy more at that time. We have 3 consecutive down candles in here, right in here. Okay, the order block really begins at this candle's opening, not this last one. You can use that one if you want to be ultra tight on your stops, but you're really going to be using the opening on this candle because it's the highest open of the 3 consecutive candles. So that's this candle right here. Open comes in at 113.28, and this candle, its open was 113.26, so it's only 2 pips below it. And you can see, look at the movement off of that level. 1, 2, 3 times you could have bought and caught that last piece. Now, that's not a long-term position trade, mind you, but it is what you'd be focusing on to see more upside pressure on this move once you had already been in it. Every down candle here, okay, price trades to it here and then comes back down to it here, right there. In that moment right there, adding the spread, you could probably get another position on there. But more likely, this is one as well. You have a down candle, the price trades through it, come back down into this candle. What is the high on that candle? High comes in at 111.39. The low on this candle comes in at 111.36. So that's definitely an opportunity for you to get in and get new longs on. So having these levels from the monthly and the weekly on, it gives you context to what to reach for on the lower time frame daily when you're executing long-term trades. But more importantly, not that I could show it here, but if we would have lost, say for instance, this candle here, in other words, it traded down below it, we could look for another return to this order block here as the high end. Not down this deep, but we could expect for it to trade back down here and give another buy. And what I mean by that, any bullish order block or any supportive roll from a PD array on a daily chart, if it is bullish but it fails to give you a buy signal or a support price, the next level you drop back to is a weekly PD array. So you're going to be looking for something bullish to support price on the weekly chart. If the weekly chart PD array has no support and it breaks, then you'd go back to the monthly support. So because you're trading off of long-term perspectives and higher time frame charts, the retracements can go through what you see on the daily. The daily isn't going to support a monthly retracement. It just isn't going to do it. Sometimes it's going to give way, it's going to break through, and it's going to pull all the way back to what you would otherwise not see unless you were looking at a monthly chart. So by having the monthly PD arrays on your charts and looking for them also on the weekly chart and having those levels on both monthly and weekly on your daily. Now, it's not going to be on your executable time frame chart. Okay, it's not going to be there. But you should always have in your platform the asset that or the market you're trading. You should have these monthly, weekly levels on, regardless, even if you're a day trader, because it's going to surprise you how many times it has great impact or significant impact, even in day trading or short-term trading. Swing trading, you're going to definitely need it. But position trading, it's absolutely crucial. You definitely need it here because it's going to frame what trades you're taking, and it's going to provide you support structure in the form of supportive resistance or natural support for price to find new buying and or new resistance to find new selling at. the takeaway from this is if you're following the market on a daily chart, just because there's a bullish order block or a void that gets closed in or fills in a gap and that supposedly is bullish, doesn't mean that it's going to keep price up from that point. Price could come back on the daily chart and retrace rather deeply. See, this is a one-sided market delivery here. The market's been priced in on one side. They completely keep running it higher, higher, higher up to a logical level, which was that weekly bearish order block. The market moved from a discount all the way up to a long-term premium. Notice on the daily chart, understanding order block theory, you could see that as a viable upside objective. But for those that simply look at the higher time frame weekly for levels to key off of, this is a logical area because it's very clear and distinct. It's the last up candle right before the down sharp move. So that's going to be your bearish order block. The opening on that candle comes in at 118.61. The high comes in on this candle at 118.66. That's precision. I mean, that's really, really tight for a weekly chart. It's hard to deny precision in that case there because it's irrefutable. So when we look at price, every one of these new these ranges in here, they're all tradable. So even if you don't have the wherewithal to hold all the way through to get to the deep premium market, you can get a premium here on this range. This is a premium from this high down to the low. These highs in here down to that low is a premium. But as you go through and deeper, this is where the last opportunity for the highest premium in unloading along from that down here in these discount area. So moving from higher time frame charts to the daily, monthly, and weekly levels, moving them onto your daily chart, that's obvious. It's just transposing higher time frame support resistance ideas. Okay, but we're using the PD arrays in terms of understanding institutional order flow. But the main takeaway is if we lose a level that's arrived at only on a daily chart, you could drop back into the levels that's seen on a weekly chart. And I'm going to show you what that looks like now. If you look at just a horizontal line, all right, we have this old high back here, equal highs. I'm going to use that. And let's see what that looks like on the daily. We have another one here, right there. And we have another one right there. And all this consolidation, this down move here, the candle making a swing low in here. We're going to look at that as some early scaling in long. They were buying here, they were buying in here, they were buying in here, they're buying in here, they're buying in here, they're buying in here, they bought in here, and then boom, you see that big move. Long-term hedging, that's what you're seeing in here. Every time there's a down candle and then there's a subsequent up move, you know that they bought, and that's the footprint. They move the market by doing that. And every time they do that, it allows new scaling in for them. And their positions are large, and they can't get them all in one time. So if we go out to the daily again, you can see there's that order block right here. And here's that order block here, that level, trading right down here. Now, it's not going to be right to the point, okay, or right to the pip, if you will. But you can see how these levels draw your attention to where a future order block on a daily time frame may occur. So it gives you an opportunity kind of like to anticipate when the next down candle should occur in terms of price, not time, but around the time of this price hitting this, you want to be focusing on when is there a down close on a daily chart, because that's going to be new buying opportunities, especially if you have a higher time frame premium level that's still unmet. So hopefully this is giving you some insights about how you can use the PD arrays in a context from moving to monthly to a daily. If I want to be specific and make sure that you've drawn something of value out of it, is not because we can take higher time frame levels and transpose them onto a daily chart. That's not the point. It goes beyond that. If we lose a level, if we lose a order block, for instance, like we see here, okay, we saw price trade down and it moved up. So this could have been a bullish order block. Price came down here. Why didn't it go up? Why did it come all the way down here? It went through this down candle to go right back into, which is a higher weekly order block. It wasn't until we saw the election of Donald Trump, that's what this big whipsaw move was, where they took out the stops here, and it had to trade all the way back down to the lower weekly bullish order block, which is what this is. Now I'm showing you on the daily chart, but this level is all on that lowest weekly bullish order block. So again, you can see how this low here, it was violated, but it went down to the most logical area on the weekly chart. So the daily chart was pushed aside, and the values that's attributed to using daily time frame, that wasn't sufficient enough. The banks went back to recapitalizing a level on the weekly chart, and that's what this whole move is here. Usually when you see these big surges higher or lower in price, and you're watching it on a daily chart, or if you see it on a lower time frame, you just can't understand what's going on, quickly go out to a weekly chart and you'll see what they've done or what they're reaching for. And then many times what everybody else gets afraid of to go back into if they got knocked out and take a loss, like for instance, say you bought down here. Maybe you bought this low here as a old low and you bought it as sell stops being ran out. Okay, great. Bought it, you started to see some money, and then all of a sudden this, boom, you get knocked out. If you go and look at the weekly chart, you can see that all that was is a return back to that weekly order block. And if it was starting to trade back up to this level here, you could be a buyer again, because you know that they went down to the weekly order block and there's nothing to worry about. All they did was recapitalize a longer term PD array, and that's all it was. This is a return back to a bullish order block on a weekly time frame. So if you lose a level on a daily, don't be concerned. Just go out to a weekly chart and you'll see what they're reaching for. If you can't find it on a weekly chart, which is probably unlikely, but if you can't, go out to a monthly chart and you'll probably see much clearer where they're trying to push price. The algorithm is going to work predominantly on a daily time frame. But if the levels are already worked enough and already absorbed all of the potential liquidity because it's already been trading to them, it will go out to that larger open float, and that usually will dip you into the weekly ranges. So when you see the market move into the weekly objectives or the levels that we identify with these PD arrays, then you'll know that you're probably going to have a really significant price move because of the weekly level. Those large funds, banks, and institutions, they're all going to dogpile on those levels because they're significant and they're long-term and they're poised to make moves like this. So until next time, I wish you good luck and good trading.